That's a really important thing that anybody's been around for a while knows. It's a probability game. All you're trying to do is shift probabilities in your favor. So when I talk about a long-term trend, well, the probability of it going up tomorrow versus today is higher, which is much better than if you're trading a short-term chart, which could be moving around. So your probability goes up. That's all it is. And you have to understand that the probability of trading is, most of the best traders in a shorter term time horizon will be at best 50-something%.
The premise behind Raoul Pal's belief that Bitcoin miners might revolutionize energy grid efficiency is that mining is a flexible, responsive energy consumer that can instantly balance the grid, not only a crypto-related business. Because miners can switch on and off in a matter of seconds, they serve as an elastic demand buffer, absorbing excess electricity during periods of high production and turning off during periods of low production, thereby reducing volatility in grids that rely heavily on renewable energy sources. By generating new income streams for previously wasted electricity, their capacity to monetize stranded energy, whether from flare gas facilities, remote hydro, or solar, wind oversupply, improves the financial incentives for the growth of clean energy. Miners assist in resolving intermittency issues that have previously hindered the development of renewable energy sources by collocating alongside them. Similar to how early internet data centers changed the demand for electricity and bandwidth, Bitcoin mining is viewed in this perspective as a structural element of contemporary energy infrastructure. This change presents Bitcoin as an optimization tool that boosts resilience, efficiency, and renewable viability rather than as a load on the grid.
When I approach the world of macro is just looking at global opportunity sets in any asset anywhere in the world that makes you the most returns. That's really what we do. But we use economics to understand how the world works, because things like the business cycle drive returns of assets. So we use that framework, and then we look at the assets that work. Generally speaking, in the past, I would have broader portfolios and shorter time horizons. My short-term time horizons, because we're trading economic data, might be 2 months to 6 months, and sometimes I do shorter-term bets. But now we've got two mega trends, the biggest secular trends we've ever had, and we'll talk about why they are as they are, but they're so powerful that all you need to do is capture the trend. So it makes it easy, because trading's actually hard. It's a really hard thing to do. And when you've got a huge trend that just does this over time, capture the bulk of that. So what I think for people to do is have two things in your head. One is put some of your capital in the long-term trend and just let it play out. Then you can try and see if you can add alpha versus that trend by trading. I guarantee you won't. That's the hard thing to realize. The trend is, like in crypto, is so powerful that it even becomes difficult to start a business if you've got any capital, because the returns are so high. We've never had this before. It's the easiest and best way to kind of unfuck your future is having a mega trend behind you. Most other things we trade are cyclical. Whether it's the dollar or rates or equities, different. Technology, definitely not. It's a secular uptrend because tomorrow's more digital than today. So focus on part of your portfolio. The largest part should be in capturing these long-term trends. They're easy. You don't need to do anything. But I know people like to trade. It makes them feel good, gives them some adrenaline. So do that with a smaller amount and then write down whether your returns are actually beating your benchmark. Chances are they won't. It's kind of changed a little bit because I've seen a lot of Gen Z and the millennials when they started trading, which was only back in 2020. Before then, they didn't trade at all, right? Non-financialized. Is they've approached it in a different way. So it's not for me to say, because we're all going to learn the lessons we have to learn in the way we have to learn them. My age group tended to learn via reading, understanding first, and then put it into action cautiously. The Gen Z generation is the most extreme of all, which is show me the trade. I don't know what it is. Show me the ticker and I'll buy it. and then I'll figure it out as I go. And I don't mind whatever way you get in, as long as you learn and you realize that you're going to make mistakes, because trading is all about learning from your mistakes. It's rarely ever learning from your winners. It's like, where did I go wrong? What did I do? Most of the time it's because you've done something dumb, like listen to your friend and they said, hey, buy this. You buy, you have no reason why, you don't understand. But as long as afterwards you go, well, why did I do that? Why did I lose money? Then you're starting to learn. So it doesn't matter whether you come the slow way, watching Real Vision, watching every interview, trying to understand how to trade, what is it like to invest, or you just throw yourself in the deep end, lose money. The worst thing is actually when you make money too quickly in the process, because you start to think you know everything. And what you start to do is start taking outsized risks. And I've seen many, many people blow up from doing that by, it's better to lose money first than it is to make money first.
Robert Kiyosaki's increased interest in hard assets, such as Bitcoin, gold, silver, and even Ethereum, is a result of his conviction that the world financial system is about to experience a catastrophe brought on by the United States' mounting debt and continuous currency devaluation. He contends that due to budgetary mismanagement, fiat money is degrading and that real money, or assets with inherent scarcity and international recognition, is becoming more prevalent. Jim Rickards' systemic risk modeling and long-term monetary cycles are major sources of inspiration for his ambitious goals, which include getting Bitcoin to $250,000, gold to $27,000, and silver to $100 by 2026. Tom Lee's belief that Ethereum will serve as the foundation for future financial infrastructure, also evident in his inclusion of the cryptocurrency. In order to support his claim that decentralized assets will prosper as faith in centralized institutions declines, Kiyosaki frequently cites Gresham's law, which states that bad money drives good money out of circulation, and Metcalfe's law, which values networks by their user growth. He accuses the Federal Reserve and the U.S. Treasury of creating fake money, implying that future liquidity injections intended to control the nation's soaring debt will cause a sharp increase in hard assets. According to his perspective, the next 10 years will see a change in the monetary system, with Bitcoin and other rare digital assets acting as lifeboats in a sea of declining currency values.
That's a really important thing that anybody's been around for a while knows. It's a probability game. All you're trying to do is shift probabilities in your favor. So when I talk about a long-term trend, well, the probability of it going up tomorrow versus today is higher, which is much better than if you're trading a short-term chart, which could be moving around. So your probability goes up. That's all it is. And you have to understand that the probability of trading is, most of the best traders in a shorter term time horizon will be at best 50-something%. So that means most of the time you're going to feel like a moron. And that's okay, as long as you understand why. Some trades just don't work, Just because the probability is 80% in your favor, it can still fall the other way. But if you're making mistakes because you don't know what you're doing, you don't know why you're doing it, you're not reading the charts right, you're not stepping a stop losses right, or however you're doing your trading methodology, if you're not learning from that, then you're destined to fail. But as you say, if you get into a trade, your first trade, you do it big, you get 3 or 4 winners, you don't realize the probabilities are still that you're going to have some losers. And if you then start putting your ego into the trade, it's the whole behavioral aspect of trading that's really hard.
According to Alex Thorne's analysis of the current stage of the Bitcoin market, there has been a change from hype-driven volatility to a more developed, structurally sound asset class. Short-term capital was drawn away from Bitcoin as investor focus shifted to other rapidly evolving industries, such as artificial intelligence AI, nuclear energy, quantum technology, and even gold. After the initial fervor around Donald Trump's election as president subsided, as Bitcoin's ownership expands from long-term holders to new players, boosting liquidity and fortifying network dispersion, Thorne views this rotation as a healthy evolution rather than a sign of weakness. Thorne is still optimistic about Bitcoin's multi-year trajectory despite Galaxy Digital lowering its year-end price prediction from $185,000 to $120,000. He contends that this consolidation is necessary for long-term growth. He points out that conversations that were previously viewed as fringe, such as deep regulatory frameworks or dangers from quantum computing, now show how Bitcoin has assimilated into the mainstream financial infrastructure. According to this perspective, Bitcoin is not dwindling. Rather, it is entering its next structural phase, shifting from periods of speculation to a long-term position in international macro markets.